Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner's off this week. Coming up, we'll get the latest on the trade front when we hear from Inu Manak, fellow at the Council on Foreign Relations. But we begin this morning with markets. The dollar slipped for a sixth consecutive session Friday, poised for its longest losing streak since March of 2024. That's after President Trump tapped Council of Economic Advisers Chair Stephen Miran to serve as a Federal Reserve governor. Earlier in the day, Miran threw his support behind Governor Christopher Waller to succeed Fed Chair Jerome Powell. Both have echoed Trump's call for lower interest rates. For more, we heard from Ivy Ng, Chief Investment Officer for the APEC at DWS. She spoke with Bloomberg's Haidi Stroud-Watts and Paul Allen.
Ivy, great to have you here. Just want to get your thoughts there on this movement at the Fed, a new governor potentially for a few months at least, and Stephen Miran. He'll, of course, just be one voice in the room. But Chris Waller is chair. How does that sound?
I would say instead of commenting on a people movement, we more focus on the data itself, because from last Friday labor market data is clearly showing the weakness of the labor market. And we will look at the Federal Reserve there, two key mandates they look at is one is inflation. Of course, inflation data is going to move higher with the tariff that we are seeing on the market, but the labor market weakness, we anyway trigger the Federal Reserve to go for more the dovish stance. So if we look at next 12 months, we still believe that there will be 4 wage cut on the table.
The people in the room, though, do make a difference. I mean, both Stephen Miran and Chris Waller, you'd probably describe them as doves, more likely to ease in 2026.
So you probably make the easing easier.
Yeah, for sure. So where do you see the cash rate heading in the U.S. next year?
We are seeing about there will be a 4 wage cut, each of them about 25 basis points. So that having more dovish Federal Reserve governor on the table is definitely better. But at the end, the Federal Reserve is still more data driven. So we focus a lot on the economic data.
Does that return the idea of sort of American exceptionalism in U.S. assets, or is that still a quandary as long as the trade uncertainty continues?
I think that still depends on what is the data looking at. When you talk about U.S. exceptionalism, so we look at the economic side, look at the corporate earnings side. But if you compare about in terms of the economic growth that we are seeing in U.S. in this year, yes, it's still higher than Eurozone. But if you look at the next year, based on our in-house view, Eurozone will be able to deliver higher GDP growth than U.S., pretty much driven by the fiscal stimulus that Germany is going to put on the table. And this from the macro perspective, even from the corporate earning perspective, yes, U.S. in the second quarter still deliver excellent results that we are seeing in the market, particularly driven by all the tech companies. But if you look at in the Europe company, for the next year, I'm not saying about they will be deliver higher earnings than the U.S. company. At least the gap we are seeing between these two regions is going to be narrowing. So is U.S. still leading the market itself? They will still majority of the part of the market. But in terms of incremental money, we believe that there will be some incremental money thinking about on top of U.S. where will be a better place to put in when the difference between U.S. and other regions kind of narrowing down.
And you do think Europe still has further to run, but maybe more selective. What about in Asia as well?
Asia, we like Japan. I guess it's quite controversy. We actually particularly like the Japan property segment.
Okay.
Maybe market will think about if we are expecting about 2 rate hike coming in the BOJ. Why would we actually like the property segment itself? And actually, market share price is kind of reflecting it. Right now, if you look at Japan property, particularly on Japan J-REITs, it's currently trading about 15% discount to the NAV, whereas the historical average, this sector generates 10% premium. That's pretty much because of the macro impact. I'm not here to call about we are done with the rate hike in Japan. That we're definitely not putting in this case. In fact, our in-house, we're thinking about there is 2 more rate hike coming in Japan in the next 12 months that we are seeing. The key part is when you look across the global market, which markets still give you a decent spread between the property NOI yield versus the debt cost. Even you take into account of the rate hike we are putting in, there is still a decent spread in the Japan market itself. So that is the key part. And then we look at all the fundamental data, be it office, be it logistics, multifamily, all the sector itself, due to the construction shortage we are facing right now in Japan because of the aging population, the demand-supply story is actually quite attractive. And not to even touch on the corporate actions that we are seeing across the whole Japan. If you look at just particular sector with a JWIT, the buyback amount in 2024 is already higher than last 10-year aggregated number of the buyback amount. So this sector itself actually play pretty well with all the thematic we are talking about in Japan.
How about some of those really trade-exposed sectors of Japan's equity market? So what's your view on that? And do you see that trade uncertainty now receding, or is it just evolving?
I think it's it's depends on where is the expectations. Compare with on Liberation Day right now, it's basically receding a little bit. But in terms of before the Liberation Day, it's definitely all these export-focused company, a trade-related company, that we're still getting affected. But it's also sector by sector, because since I was touching on the property one, logistics was the one people kind of say, oh, does it affected by the trade? Because there's more related to the trade tariff matter. But if you look at Japan logistics sector, particularly for the property funds, it's more focusing on the domestic consumptions instead of external one. So that sector itself is actually relatively immune.
How do you feel about China? Because there's relative calm and it's fully expected that probably that trade truce will continue.
Yes. I think China itself, in terms of the tariff impact, is actually not really a key focus on the market, I would say, because if you look at between Trump 1 and Trump 2, given the amount exported to the U.S. is actually reducing, and then also the export to U.S. as percent of China GDP is also below 3% at this moment. It's still a news headline people focusing on, but a lot of focus actually have been focusing on the domestic consumption part. Is the domestic consumption is really getting better? Of course, a lot of driver is regarding the trade policy, consumer stimulus. But we did see that recently we are in between of the result season in Hong Kong, China. For some company with more exposure in the China retail market, they actually say that it's more a broad-based recovery they're seeing, not on a particular segment, not the particular on high-end or a surface store that which very popular. But what they are saying is they see the bottoming. They see that it's a broad-based recovery over there.
Ivy Ng, APAC Chief Investment Officer at DWS.
Welcome back to the Daybreak Asia podcast. I'm Charlie Pelletin this week for Doug Krisner. Indian Prime Minister Narendra Modi spoke with Brazil's President Lula Thursday about strengthening trade ties amid rising U.S. tariffs. Earlier this week, President Trump hit India with 50% tariffs to penalize it for its trade barriers and purchases of Russian oil. Modi is also expected to visit China later this month for a summit with President Xi Jinping, his first trip there in 7 years. For more on the tariff story, we heard from Inu Manak, Fellow for Trade Policy at the Council on Foreign Relations. She spoke with Bloomberg's Haidi Stroud-Watts and Paul Allen.
Great to have you with us. And, this is another example of President Trump sort of trying to achieve his foreign policy goals through trade policy, right? Do you think it will be successful, given that we know for India the issue of purchasing Russian crude is really a deeply structural one for its economy?
This is going to be a very difficult negotiation with India, and the use of tariffs as a tool for all sorts of foreign policy objectives has been sort of the method for President Trump. Now, with India, what we're looking at is the potential for these tariffs to go into place on August 27th, and that would be bringing it to about a 50% rate. That's an enormous amount of taxes that we would apply to Indian imports coming in. Now, some of the products that we're most concerned about, like pharmaceuticals, electronics, would not be affected yet, but there's a chance that all of this will be ratcheted up as well in due course, making this a very challenging negotiation that will likely have to be extended.
What does it mean for India, that has sort of in recent years become the rising counter, an ally to the US against China, right? Because China also has Russian crude purchases, but those negotiations kind of just keep getting extended, and we're seeing the likes of traditional US allies as well, like South Korea, Japan, the Philippines, really struggling to get to a point where they can get a compromise with the White House.
Yeah, one of the odd things that we've seen during this administration has been the fact that traditional allies have been treated more like adversaries, and our adversaries have seemingly had an easier time dealing with the U.S. president. So this is a very odd time, and one where there is a shift in policy that is noticeable. We saw during the Biden years, there was a lot of courting of India, trying to get India as a bulwark against China on the U.S. side, to adopt some U.S. policies towards China that were similar. But what we see here is some sort of transactional deal making that President Trump hopes to achieve through these tactics, but it's not really clear that this will pay off. And in the meantime, we see India reaching out to others like Brazil, like China, and that could actually threaten long-term U.S. objectives.
Yeah, again, to your point on timing, that timing is interesting. Narendra Modi is going to be meeting Lula da Silva, first visit to China in 7 years. The timing is coincidental. But India, of course, has a long, long history of non-alignment. Do these meetings to some degree help India position for life outside of the U.S. sphere?
In many ways, that's the trajectory that India was taking for a long time. And only more recently have we seen this pivot whereby India is looking to strengthen its ties with the United States in a more productive fashion and to pivot away from some of those relationships. But I think President Trump has made pretty clear that he is opposed to the BRICS countries, including India, from taking on any sort of counter to U.S. power across the world or setting up a currency, for example, that would be a BRICS currency. So I think what we're seeing is sort of the BRICS countries, again, sort of aligning a little bit on some of these issues, and perhaps that could lead to a little bit of pressure on the United States to change course in its current policy.
And we heard from Narendra Modi a moment ago. I mean, he vowed to protect Indian farmers at all costs. I mean, domestically, politically, there's a lot on the line for Prime Minister Modi here, isn't there?
Oh, absolutely. You know, India is one of the toughest negotiators you'll ever sit across from. They have been persistent in maintaining fairly high levels of protection on many markets, and their tariffs remain fairly high. And India has not been willing to back down on that for a very long time. So I think for the Trump administration, this is an attempt to sort of force India to make those systemic changes that have been problematic for quite a long time. And I'm not quite sure that India is going to cave across the board on all these things. But as we've seen with the deals that have come out so far, there are certain carrots that have been given in order to lower these tariff rates, and other countries have been willing to give something back to the United States, whether it's in investments or in reducing some targeted tariff barriers. So I can imagine that India could strike some sort of deal that still maintains quite high levels of protection and yet gives the United States something that it can live with.
Do you see sort of fundamental changes when it comes to realignment of strategic relationships within Asia, particularly pertaining to the global south? We've seen efforts by Beijing already to do that. Do you think some of these changes and sort of realliances, if you will, might be longer lasting than just this US administration?
It's entirely possible that we could see global realignment of a lot of different economic and diplomatic relationships as a result of the Trump administration's tariff policy. You know, we're already starting to see trade patterns begin to shift. We're seeing some partners of the United States look for other markets to diversify their exports. And so I think that could lead to more permanent changes the longer that this goes on. Now, of course, there could be a reversal in the future. The courts are reviewing the current tariffs that have been put in place, and that could overturn some of these tariffs. They could still come back in terms of other statutes and laws that the president could use to enact additional tariffs. So I think that for the remainder of President Trump's time in office, this is going to be a rocky couple of years, and allies are going to have to weigh whether or not they're going to wait out any substantive change in U.S. policy before they make substantive shifts in their own.
All right, Inu Manak, Fellow for Trade Policy at the Council on Foreign Relations.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.